There is no denying that new investors may find the world of investing to be highly complicated. Fortunately, we're here to help, and we have some investment advice to ease your burden and empower you to take charge of your journey. Before we go further, support the channel by liking this video and subscribing to this channel for future updates. Number 1. Consider investing as soon as you can. If you put off making an investment, you can miss out on some good development, which is not ideal if you want to maximize your prospective earnings. It can be worthwhile to get into your FOMO's pressure to invest if you want to get the most out of your financial trip. Consider entering the world of investing as soon as you can, because the sooner you start, the faster your money could increase. Number 2. Invest as much or as little as you want. It's a common misconception that only men in gray suits should engage in investing. This may have been the case a few years ago, but thankfully things have evolved and everyone can now invest. Because a little can go a long way, you can invest as little as $1 thanks to online investment platforms like Wealthify. For instance, if you contribute $30 every month for 25 years, you might end up with around $18,529 in total. Number 3. Think about what you want to invest in. There are many various assets available to develop your portfolio if you're just beginning your investment adventure, so it's crucial to choose what you want to invest in. What kinds of investments would you like to have in your portfolio? The answer will mostly rely on how you feel about taking risks. Number 4. Consider diversifying your portfolio. Attempting to reduce your risk is always a good idea, regardless of your investment strategy. By distributing your funds throughout various investment categories and geographical locations, you may diversify your portfolio and reduce the risk of losses. Consider this. If you put all of your money into 1 or 2 businesses, you can get a rude shock if those businesses fail. Now, if you purchase a variety of investments of various types, such as shares, bonds, and property, and participate in several financial markets, the risk that you will lose all of your money will decrease. Number 5. Have a look at ISAs. You can invest your money in the stock market with a stocks and shares ISA and avoid paying UK tax on any gains, allowing you to keep more of your original investment. You have until midnight on April 5 to use your ISA allowance, which is up to £20,000 each tax year, subject to change, in your stocks and shares ISA. And since you don't receive gifts from the government every day, it could be worthwhile to think about your allowance before the deadline passes. Number 6. Start thinking about your pension. It's never too early or late to start planning for your retirement. While it may not be your top priority if you're in your 20s to start saving for retirement, it may be a good idea to start making plans now and getting your finances in order so you can start controlling your retirement sooner rather than later. Checking your state pension and employer-sponsored pension savings now, if you're in your 30s or 40s, could be a wise move. Then start pondering crucial issues like, will it be enough to retire? Is there a method to enhance your retirement income if not? Opening a personal pension, also known as a self-invested personal pension, SIPP, may be able to help you increase your retirement savings. Number 7. Go ethical if you want to. There are numerous ethical investment options. You can open an ethical plan that is managed by professionals on your behalf, or you can do it yourself and choose your own sustainable investments if that sounds like too much work. People who oversee these funds investigate the operations and policies of corporations and make investments in businesses that either uphold high ethical standards or make a significant effort to do so. Additionally, every company in the fund is closely watched, so if a business slips up on its standards, it will be kicked out of the fund. Number 8. Try to remain calm when markets fall. Financial markets resemble roller coasters in that they experience ups and downs, and as an investor, you must expect a bumpy ride. There's no disputing that seeing markets decline can be unpleasant, but it's crucial to keep your cool under pressure. Selling your investments will result in the realization of your losses. Your losses will simply be a figure on your dashboard if you maintain your composure and resist the impulse to sell. So if markets recover, you might notice an increase in the value of your investments and ultimately make money in the long run. However, if you attempt to timing the market and quit playing when markets are declining, you can still miss out on the positive days and the potential rebound. Number 9. Think about the long term. Let's face it, most of us dislike waiting. Patience is getting harder and harder to come by in a world where you can get next-day delivery or watch TV on demand. But you must have patience and a long-term perspective if you're serious about investing and want to maximize your potential gains. With that in mind, it's important to note that you would have had an 88% probability of making a profit if you had invested in the FTSE 100 for any 10-year period between 1986 and 2022. Number 10. Get help if you need to. Even while investing can seem intimidating, it need not be. With a few taps, you can start investing thanks to digital investment platforms. Simply select the type of plan you want to open, the amount you want to invest, and the level of risk that is right for you. We will take care of the rest, including selecting your assets and modifying your plan as necessary to keep it on course. It's never been simpler to invest. This brings us to the end of our video. At the end, please don't forget to press the like button and subscribe to our channel. Thank you so much for watching. See you in the next video. Stay tuned.